Welcome to this presentation on the simple interest formula presented by Stratfield Solutions as part of our Finance in 5 Minutes mini-series. If you like this video, please give it a thumbs up and subscribe to the channel for additional video updates. Today we're going to be looking at a very simple, hence the name, simple interest formula that will allow us to calculate interest earned on a deposit, or in the case of a loan, how much you would have to pay back in payments, as well as what the total would be using the simple interest formula. So as a quick overview, simple interest is in fact simple. Instead of a more complex compounding, you may have heard of compound interest, we can actually calculate an amount that is earned each year or needs to be paid each year, depending on whether you're the depositor or the borrower, by using one simple formula, and we'll show that to you in a minute. This formula, the simple interest formula, is often used when estimating payment amounts. In a scenario like a mortgage, they may say, hey, you take out a $300 mortgage and you need to pay 6%. The math that you're doing in your head is 6% times the loan value, $300,000. That is a simple calculation. You are not looking at the time value of money. All you are doing is saying we're just going to take 6% of the total loan amount. So it's often used when you're estimating something, or in an instance where a less complicated calculation is not needed, and is in fact you want to have a simple calculation. So the formula is as follows. The interest, again simple interest, is the principal amount times the applicable interest rate times the time period. So we'll walk down through each of these inputs, where the principal is the initial amount invested. Again, I'm displaying this as if you were a depositor putting money into a bank account and trying to see how much interest you would earn. It could work the other way. If you were calculating what the amount of the payments needed to be on a loan, the principal would be the amount borrowed in that case. The rate is the applicable interest rate. Generally, in simple interest, you are given an interest rate for an entire year. We would have to do a further calculation if it was given to us in a period of something other than a year. So for the purposes of this demonstration, I am going to assume and present these problems as if there is an annual interest rate. And T is the time period. Now, as we just mentioned, the time period could be something other than a year. So if the interest rate is stated in years, then our time that we're multiplying by should also be stated in years. And that may require a conversion, which I will show you how to do in the next slide. So some tips and cautions. This formula, simple interest, cannot be used where there's multiple payments. You're not looking at a recurring payment or recurring cash flow here. You're looking at a one-time deposit or a one-time borrowing only. And so you shouldn't be trying to calculate multiple payments using this simple formula. Now, from the caution I presented on the previous slide, if you're using an annual rate, ensure that the time period is expressed in annual terms. For example, if I give you a 5% annual interest rate and I say that the investment is for half a year, your time would be 0.5. It's half of the year. A lot of times you'll be given a certain number of days, and you would take 90 days divided by 360 or 365. So another example here, if the problem states a 10% annual rate, but the loan is only for 180 days, you have to convert the 180 days into a fraction of the year divided by 365 or 360. Speaking of that, some textbooks and problems use a 360-day estimate for a year rather than the full 365, and you'd want to consult the problem to determine which they are using. They just do that to make the math a little more simple and not have a rounding issue at the end. So first sample problem, what is the amount of simple interest received on a deposit of $1,000 if the annual rate of interest is 6% and the investment will be in the account for 180 days? Assume a 360-day year. So if you want to pause the video and try to solve this on your own, and then resume, I'll present the solutions here in a second. So hopefully you're able to get this. $1,000 principal times the 6% rate times 180 over 360. And again, this is where we've converted the annual rate into a half year. This would give you $30 of interest. So let's look at a second problem. Now in this one, we're going to ask for the total amount in the future. So we're going to add the principal that we initially invested. What is the total amount received on a deposit of $1,000? The annual rate of interest is 6%, and the investment will be in the account for 3 full years. Again, if you want to pause the video while you solve this. So what you should have here is 1,000 of principal times 6% times 3 full years plus $1,000 of principal returned. So this will give you 1,180, which is made up of 1,000 in principal plus $180 of interest. And that's all that there is to the simple interest formula. Again, if you like the video, please give it a thumbs up and subscribe to us for future Finance in 5-minute mini-series updates. Have a good one.